Welcome to my YouTube channel, and this is Premium Capital. And today let's dive deeper into the reason why most of retail traders lose their money. The reason behind it is what we call liquidity. The problem is that most of people are not aware of this, what we call liquidity. Even those guys who are trading liquidity are still not aware. Let me tell you, liquidity is just a stop loss. This can also be a pending order. It is where these guys where the market gets money to push the market. Without liquidity, market cannot move. So how do they get this, what they call liquidity? It is from the market. It is from the retail traders. And how does this liquidity being formed? It is through those concept of retail traders. So most of retail traders trade by using support and resistance, double top, double bottom, and trend lines. So we can get liquidity by just thinking like those big financial institutions. So if you're just a BFI, big financial institution, banks and other kind of those institutions, you look on how retail traders trade, those concepts which are very famous, which are very, very used with most of people who are trading the Forex market. So liquidity is just a stop loss. This is money, okay? So today I'm going to show you how are these support, resistance, double top, double bottom, and trend lines used to manipulate other traders. So we have different types of liquidity depending on how these financial institutions, big financial institutions, are likely to trap these retail traders, okay? So we have what we call trendline liquidity. We have what we call range liquidity. That is where we have support and resistance liquidity. We have equal lows. That is where we have double bottom. Then we have equal highs. That is where we have double top. Okay. So let me show you. This is what we call trendline liquidity. This is when most of traders are looking at this kind of structures. So for example, you have an uptrend here. So you can see the market is moving, creating higher highs, higher lows. Most of retail traders believe that if the trend line is drawn here, after the third touch, after two touches, the market has to, if the market come back again, that means this trend line is valid and therefore they can take a trade on this trend line, something that is very long, because at this time is where they are creating liquidity. Below this trend line is where these guys are looking to take out these stop losses, because they know most of you guys are buying at the touch of this trend line and putting your stop losses below. That means they will come back and take out those stop losses. And sometimes they will pretend like there is a breakout there and you can start selling again. That is where they will take out all your money. Okay. You understand? So retail traders are taught to buy at a trend line or wait for the blackout of that trend line to go short and vice versa. With this, it creates a lot of liquidity at these areas that the markets will manipulate to grab liquidity before larger move in the markets can take place. So always the market will move to that side to take out all those liquidity, which means stop losses, before the market moves in the right direction. So let's take an example. You can see. So most of people here were thinking, because this is retail traders were thinking, because this is an uptrend. So they were believing that if the market is just going upward, then they can just draw a trend line, as you can see here. Okay. And they can be taking buy trades on these touches in the trend line. You can see what these guys did. Okay. They came down and they took all the liquidity below this trend line here. And what they did, they started going up. Some guys here thought maybe because it is a break of the trend line, retail traders started selling. And that is where they lost their money. That is where the money was lost. Why? Because this guy knows the mindset of most of the retail traders. That is where the money was taken. So that is trendline liquidity. Let's talk about range liquidity. Range liquidity is where those guys are trading double top and double bottom. Okay, you understand? So support and resistance can be classified as range, okay? Retail traders are told to buy at the support and sell at resistance. This will generate a large amount of liquidity above and below these areas in the market. And this is what we call accumulation. That's why here you can find these guys are going up to take liquidity and sometimes coming down to take liquidity before they decide where to move. Let me show you here. So you can see we have these equal highs, equal lows here. Range liquidity, call it range liquidity, accumulation. So most of guys here were thinking if the market break upward, they are going to take a buy trade, these little traders. And what happened? These guys, they will always come back down here and take out another liquidity here before they decide where to move. And this is what we call stop hunting, manipulation of the market. So if you are not aware of the liquidity, my friend, you will always lose money. So you have to know, what are these guys doing here? What are they creating here? If the market is moving in this way, what is going to happen? Am I going to be a liquidity? Am I going to be a liquidity or not? This is the easiest way you can understand. So equal low, that is where you can find a double bottom here. Okay. So equal low, or what we call a double bottom, by the little side of trading, people told to buy at the double bottoms, which of course generates liquidity below these areas. We know that these areas are get manipulated, so we expect the price to come to these levels. So let me show you. So you can see here, we have this what we call equal lows here, okay? Equal lows. Some people draw what they call here support. And when the price break that way, they sell. Something that is very, very, very bad. At the end of the day, you can find the market is going upside. It's going upside because we had what we call fair value gap here below. So this is what we call a liquidity. So when you're drawing liquidity, just look at double bottoms and double tops, but also trend lines and other kind of structure that I have taught you there about. Equal high liquidity, you can see the way it is, double top. In the structure, you can see we had these structures here, you can see we had equal highs here, and that was the reason why this market came up here, took out liquidity, clapped liquidity, and then it came down. That means we had some stop losses here. Most of people had stop losses here. Okay, they saw that is the point of selling, putting their pending orders here, putting their stop loss above to sell. Why? Because they are saying here we have what we call a resistance, and that was not something that you can use. Resistance is something that will destroy you if you are using a resistance without knowing liquidity. So you can see here the market went up upside, and then you can see after taking all those stop losses or liquidity, the market came down bearish. It's very, very high momentum. This momentum here coming down is the confirmation of what we call liquidity grab. You see, but for someone who knows how to trade like institutions, you could wait for the price to come back here because you have an order broke here. Price, you can see the price came there. We had a choke here, change of character. Then we had our zone here. Let me show you. Let me show you in a very simple way. This is the easiest way you can understand about liquidity. This is the easiest way you can understand about what we call liquidity. So let me show you here by using, let me use this one. You see, so someone who is aware of what we call liquidity could not just buy here because the market has broken this level here, equal highs. No. You had to wait for this price to come down so that we could have what we call change of character. Here you can see we had change of characters. Okay. Then we had to wait for this mitigation there. Then we could sell to what we call unmitigated order block down there. You see. So this is one of the very, very important concept in trading. If you're not aware of this, my friend, you can lose a lot of money because you're going to be the source of what we call liquidity. So these are the types of liquidity. This is the concept behind liquidity. So you can understand now that liquidity is the concept against the little traders. If you want to know how to trade against little traders, then liquidity is the name, okay, that game, okay. The easiest way to trade like banks is to go against little traders. In order to trade against little traders, you have to know about liquidity. And when you're aware of liquidity, that is the easiest way you can trade the market. I think you have understood this. So make sure you subscribe, you like, and comment. If you have any question, you can just ask it there below. And I'm there to prepare a video for you. Have a nice day. Love you all.